This teaching is my market maker models, its algorithmic price delivery, and institutional price swings. All right, so I guess in a lot of ways, this is just basically my interpretation and creating a language around swing trading. Now, when I say swing trading, what I'm referring to is if I'm bullish, I'm trading from discount to premium, riding the coattails of buy-side delivery. If I'm bearish, I'm trading from premium to discount, riding the coattails of sell-side delivery. Now, when I mention buy-side and sell-side, you're thinking liquidity. And I'm going to draw a distinction between the liquidity and the delivery. All right, so imagine, if you will, that you were looking at price and those relative equal highs right here that we're looking at conceptually. We would anticipate a run above that. Now, if you can get that far, for the sake of this discussion, the understanding is we should be able to see those relative equal highs, and that being this here and this here. Now, I'm using a close line chart, so it's going to be a rather crude depiction of a general idea. Okay, we'll transition to actual charts in a moment, but for now, I want you to just think conceptually how if the market's going to run eventually up above that, and if we could hold a bearish stance, meaning that we look at every rally as a suspect rally if we're bearish, and then we're going to be looking for some measure of reversal, and then once that reversal is qualified, that meets the criteria for a market maker sell model, then we can go in and engage it. Now, an advanced interpretation of this would be anticipating the run above these relative equal highs here and being long prior to it. And the most advanced form of it would be to buy it during the buy side of the curve and then short it during the sell side of the curve. That is very advanced. And while I do have students that can do that, so I want you to take a look at that price movement here. If this is a market that you'd be trading or interested in learning, these ideas are universal. So it's not a matter of it only applies to futures or it only applies to index futures or Forex. It's universal. This whole idea from this run up to that level there, this is what I refer to as buy-side delivery. Okay, so when price is running higher, it's offering buy-side. It's giving the marketplace buy-side as it's running higher. Now, for the purposes of running above this high and this high, it's running up to engage the liquidity that would be resting above these relative equal highs. So the distinction here is the directional movement when it's going higher, prices in a buy-side delivery. Liquidity above a single or a group of highs, that is buy-side liquidity. That's orders that are pending, whether it be a buyer to break out and go long or to protect a short position. Buy-side delivery is the actual animated movement of price moving higher. And as you probably would have guessed, when we're looking at price going lower, this here is what I refer to as sell-side delivery. So the express purposes of running above these relative equal highs, that function has been performed. So now price could, if we're bearish, move lower and then trade back below the previous rally low. So it's buy-side delivery to the upside to engage liquidity, trap traders long, and smart money would go short here and ride it back down to stop out any individuals that were lucky enough to be long in this but kept a stop loss here or inside this run up during the buy side delivery. Their stop loss will be tagged out. And again, with the premise of reaching for the new engineered sell side liquidity, which would be the sell stops on longs that anyone would have been going long here, their stop loss would be priced right below here. So it's the rally up to take buy side and then rip right back down to take the sell side on those individuals that were trying to go long and weren't astute enough to reverse or, at the very minimum, close out in a profitable position. Now, as I promised, we're going to look at it through the lens of open, high, low, close candlesticks. So take a couple minutes, look at this before I continue. Pause the video before I start talking and make observations about what you think you see here, what's salient to you. And when you're ready, unpause the video. All right. So what we're looking at here is basically the same idea of price action. Instead of a line close chart where every fluctuation is only noted by where the interval will be utilizing that closing price only, not the highest high and the lowest low, but the closing price. Here we're looking at the highest high and lowest low and the open and close of every individual candlestick of this respective time frame. So we see the relative equal highs here with this high and this high here, and the market rallies up here. So all of this is the buy side delivery and then subsequent sell side delivery, attacking the sell side that was created after the run higher. And this run higher attacks the relative equal highs here where liquidity is. So markets go up for two primary reasons. One, it goes up to engage buy stops, which is buy side liquidity. Or it goes up to an inefficiency. What is that? Well, if you look right here, that's an inefficiency. We have this small little segment of price action where we see that here. This candle trades up to it, but where does the close stop? Right at the high of it. The next candle, we open and we trade back down. Yes, there was a small wick here. Yes, there was a small little wick here. That is acceptable. That's permissible. But the bodies tell us the narrative. So all of this rally up here was under the pretense that we would see it just simply trade back to this little area here above the buy side, above this high and this high. So ICT, how far can it go above these relative equal highs? You'd have to look to see if there's any close proximity inefficiencies. In this case, we have one. So let's go into greater detail here, how the market ran up into this area here. Let's focus on how it went down, not just simply below the sell side of that original rally up, but it went down to this old low right here. Look real close, you'll see that it went just below that. That's not random. This right here is a buy side imbalance, sell side inefficiency. So it digs into this just by a little bit, but specifically right below that low. And it trades where? Down. Once it gets into there and reprices to the order block, then it rallies back up, creating the initial stage of what? A shift in market structure above this high here. So now we can look for a retracement back down in. So as it's retracing, we're anticipating the price doing what? Eventually reaching for the high here and here. So we can look for a lower time frame to give us a scenario where if we think it's going to go above these relative equal highs and we can see that this fair value gap wasn't hiding, it's in plain view. It should stand out on your chart. That's why you're encouraged by me to annotate them when you see them. So if you see a draw on liquidity that's setting up above or below the marketplace, don't just limit your focus to that. Look in close proximity just above these buy side liquidity highs here that are relatively equal. How far can it go above it? Well, looking over here, there's no inefficiency here, but there is one right there. So how far can it go above these relative equal highs? There. And look where the bodies stop. Okay, so that's not random. All right, so we're going to zoom in here a little bit. Drop down into a lower time frame chart here. And don't worry, I'll let you know what this is as we get to the close of the lecture, but just stick to what I'm showing you here. We have the low, buy side delivery, trading up into the fair value gap that was on a time frame that was 60 minutes, but now we're on a 15-minute. So this time frame here is a 15-minute time frame, or repriced to where? Below this low. And any accelerated run below this low, how far can it go? Is there any inefficiencies over here? Don't look at this one because that's above that low. We would already be anticipating a retracement back below that. Where will we look? The rejection block, which is the lowest down close. And then we have these relative equal lows here. And you can see it just goes a little bit below that low right there. We're going to get into this in a moment. For now, just notice that we have ran above that buy side, that old high here, that old high here. Shift in market structure on the hourly chart above this high here. So it's retracing. What's it retracing back down into? The fair value gap, order block, right there. So now, does the market offer consolidation? That's what we would be expecting here. Is it consolidating? Is it offering a small little pause in price where it goes sideways for a little while, which would be accumulating long positions? That's allowing smart money to accumulate longs. I'm going to zoom in. This is the same time frame, okay? So it's 15 minutes. Here's that low. You can see how we just went below it right here. See that? Here's that low inside the fair value gap with the order block, which is a down close candle. Again, we would be anticipating some measure of consolidation, not dropping lower. So what we're going to do is we're going to drop down to an even lower time frame and see if there's any more detail in here with a 5-minute chart. So now we're inside of a lower time frame, 5-minute chart, and I've highlighted now this little area right down here. I told you we would talk about that. In here, we're looking at a balanced price range. A balanced price range is where the market has both a downside and upside, or sell side delivery and buy side delivery that overlap one another in the same relative range in price. So you can see how this candle's high, that candle's low. That would normally be what? A sell side imbalance, buy side inefficiency. But look what's happened over here. We have a high, a big up close candle, and this candle's low. So what does that make this? A buy side imbalance, sell side inefficiency. So there's an overlapping between a SIBI and a BISI within the general area of the same price range. So I'm using the low here and the high here. So that way we can see how this becomes a balanced price range. These are trapped traders. Okay. This in here is a trap trader, or trap traders that would have been caught short. In the classic days of commodity trading, if you were to see old patterns like what would be considered an island reversal, okay, this is the closest thing that I can kind of use to describe what's occurring when there's a balanced price range, when it's extreme like this. So when we have a big decline, large range candle that's down, and then eventually, not like months later, not weeks later, but when it's a big drop and a handful of candlesticks like this. It's not a whole lot of candles, and eventually, rip back higher. That means that this was someone that's been caught. They're short, and they quickly reprice and leave them down there. So when I see that, I look to see where those two reference points are, where the market drops quickly for sell side delivery, and then when it rallies back up quickly, those one big candles down, one big candles up, all the price action below it, I would view that as trap traders. So that means by itself, that gives me narrative that it's probably going to go higher. So now cue up the idea of what would it be reaching for? Well, we see it was dropping back down into an inefficiency here, the buy side here, and the old high back to the left, and that 60-minute fair value gap, that's a SIBI up here. We're still in a 15-minute time frame, by the way. I miscued it earlier, calling it a 5-minute. See the idea of the market consolidating, that's what we're showing here. Now, how am I referencing this consolidation? This is the part of it that becomes like a knack, okay? You might not have the exact candles framed like this when you see an original consolidation. So when I call an original consolidation, that is where the market is accumulating. So what I did here, I seen these two candles here, and then the body of this one, and the body of this one. So right away, my eye jumps to that because it's what? It's a smooth edge. So I want to use that as the high of the original consolidation. What's the low? The lowest low. See how easy that was? So when I'm looking at the original consolidations, I'm looking for a repetitive overlapping or reoccurrence of a level that's being constantly referred back to inside of a consolidation. So when we can frame the original consolidation properly, then once we leave it, how are we leaving it here? Look at the body right there. So now we can then refer back to the same level here. If it trades back to that level, what's it doing? It's returning back to the original consolidation. That's how I teach my market maker and sell model and buy model. The original consolidation, it can leave it. It doesn't have to touch it, but if it does, that's usually a trade. So this would be your original entry. Okay, so you could go long there, but sometimes it won't offer a return back to the original consolidation. So it might just need a higher order entry and not offer something right at the high of the original consolidation. The market rallies up, trades right into that 60-minute fair value gap SIBI. Bodies tell the narrative it's not interested in going any higher. Why? Because look at this big candle drop down there. Wonderful. We have an inefficiency here. We have an inefficiency here. Drops aggressively below the original consolidation. Right back to the high of the balanced price range. Right there. Which we have more candlesticks, and now this is the 5-minute chart. So here's the original consolidation. You see the market does in fact drop back down in inversion fair value gap. I don't have it highlighted because it would be too many things on the chart, but for you, that's inversion fair value gap, meaning that usually that would be sell side imbalance, buy side efficiency. If the market trades back up into it, we would see it trade lower. But if it's an inversion fair value gap, it means it's going to go above it, come back down, and use it as a discount array. And it's inside of the original consolidation and it rallies. Takes the buy side, trades the 60-minute fair value gap SIBI. Even on the 5-minute, look at the candlesticks. The bodies, they're inside that SIBI. It's indicating that, yes, there's wicks going on in here, but that's just the damage, okay, where it's reaching for the best case for smart money to get short against. And then we see it drop lower. My eye sees this. Return to the original consolidation. The market rallies up. We have a down closed candle that's just below this area right here. What does this up closed candle become? Bullish breaker. Low, high, lower low. Down closed candle inside of the breaker candle over here. That's a bullish order block right there. So when it rallies up and trades back down in, our target is what? Up here. The initial draw is the liquidity above that high and the older high to the left. It's not inside this fractal price action anymore, but it's highlighted with this line. So this drop down, that could be if you're not seeing the original consolidation correctly, and this would be your original entry or your first stage accumulation. And then this would be second stage reaccumulation here, and it rallies up. But down closed candles traded to here, so there's your entry for a first stage accumulation, or it would be second stage reaccumulation if you use this as your first entry. So again, just make sure you understand that. Sometimes you will only have one point of accumulation and not have a return to original consolidation. It might just rip higher, give you one opportunity to go in, and then run real quick to it then. And then after that, bleed lower. A buy side imbalance, sell side inefficiency, consequent encroachment, which is the midpoint of this inefficiency. Did it get to this level up here yet? Nope. So this here is a bullish fair value gap, consequent encroachment, second stage reaccumulation right there. Now for some of you, you might be going long in here and then adding and pyramiding to that to ride into this level here. That might be your trade. Is there anything wrong with that? Nope. Absolutely not. Others that are high-end students that have been doing it for a long time, they're going to sell these mohawks because the bodies are already indicating that what? It's not one to go outside of that 60-minute fair value gap SIBI. So every rally up here, they're going to go short. And anything outside of that PD array's high, which is the 60-minute fair value gap, that's an extremely overbought, without an indicator, entry. We're trusting that we've already mohawked above here with these wicks. So now we're back down in here. So any attempt to trade in the middle point of this shaded area here, that could be your low risk short stop loss right above here. What happens if you get stopped out ICT? Same thing. Wait for it to go lower. Leave the fair value gap low. And if it can touch the bottom of it again, I would use that as my entry. Stop would be right back above wherever the highest high was formed, or the consequent encroachment of the wick if it formed a higher wick here. That's how I would use it. I would not be afraid to go back in. But that low is taken out right there. What does it create? Fair value gap between this candle's low, that candle's high. That could be a trade in itself, but this is a breaker. So how far is it going to go back up into it? Right there. So your bearish breaker, that is your first stage distribution. So you want to wait for the smart money reversal. You want to see a low risk short. Does it show a willingness to want to run away? Wonderful. That's tape reading. Now you have a fair value gap and you have a breaker. Trades up into it, go short. That's your first stage distribution. Does it break lower? Yes, it does. Then it does what? It trades back to where we had buy side outlined. The market rallies up here into a bearish order block, which is the up close candle here. It trades into it, digs into half of the body right there. That's mean threshold. So that bearish order block is your second stage redistribution. This is going to be the fastest elevator ride of the move going down. Now, it doesn't mean it won't be a sharp drop, consolidate, sharp drop, consolidate, sharp drop. That it can do that. But this is the one you want to be entered on. Because if you miss this one, you're probably going to be chasing price. Now, what happens if you don't see this as your low risk short and you see this as your low risk short? Where I had the first stage distribution. Is that wrong? No. Based on your present understanding, you're going to see it probably as this was the first stage of distribution to get short. And the smart money reversal was up here. Wonderful. You don't see a low risk short here in the middle of that PD array. That's okay. That's experience. I understand that you're not going to see everything that I had seen, and I'm making allowances for that while I'm teaching it. So you might see this as your low risk sell or short, and then this is your first stage distribution. So where would the second stage distribution be, or redistribution be? And it's, in other words, instead of saying this one is your second stage redistribution, which means it's going to be the highest degree of speed, magnitude, and impulsiveness to go lower, quicker. If it's not this one, and you've classified that as your first stage distribution, and this down close candle is a bullish order block. So while we were going up, when it drops back down into this, it should be offering what? Support. So when we get to the other side of the curve, which is to the right of this imaginary line, which is divided by the highest high, where we anticipate seeing the market reverse, on the right side of the curve, that's the sell side. So anything on the right side of the curve that was offered as support or as a discount array needs to start acting as what? A premium array or resistance. What's the low of that candle? Draw it through. Where's the body stopping? It's respecting it, isn't it? We break lower. Same thing here. Buy side of the curve used in reverse on the sell side of the curve. Meaning what? This down close candle, what was it? A bullish order block on the buy side of the curve. But now we're on the left side of the curve where everything should be going lower. So what is going on here? The market's trading right back up to the butt end of that body. Boom. That would be your second stage redistribution. If you looked at that as first stage and this is the low risk short, smart money reversal, and you didn't classify anything low risk, that would be your second stage redistribution. For me, that would be a pyramiding entry. So I would have even more going short. And then we drop down into original consolidation. 80% of the trade would come off. And then I would see, do we have the ability to get any deeper? And we can see it goes lower, deep retracement, and finally lower in here. So for the folks that want to know, this entire presentation was under the discussion of the British pound versus US dollar forex pair. All of these things here, folks, this occurs on every asset class. It's there all the time. Now, one of the wonderful elements that's not been discussed so far, but I mentioned in the briefing in the beginning of the discussion, is when everything with price is in agreement with time, because time sets the stage, then price does the act of precision. So it's time and price. Look what's occurring here. On the 31st, we have consolidation. We leave the consolidation, come back in, return to original consolidation. When does that occur? London open. Rallies up. Right in here, we have an order block. Right there. And then we have what? It rips into the buy side, trading up into New York open, 7 o'clock in the morning. There's your market reversal profile. Part of a market maker sell model. Time and price. Everything that was illustrated over here, now look what we're at. We're inside of the New York open kill zone. We have a breaker. We have a bearish order block. All within what? The New York open kill zone. This is also optimal trade entry. Right there. This right here is model 2022. Buy side taken, shift in market structure, fair value gap, go short. That's model 2022. Ooh. This right here, trading up into that is the 7 o'clock in the morning to 9 o'clock in the morning, New York open kill zone, silver bullet. Man, how many silver bullets? I got a whole rack of silver bullets. Fair value gaps are always forming, folks. You have to understand what the narrative is in play for that session or that operating time that you're using for your trading day. I'm using times of the day that have high intakes of volume, where order flow is increasing. It's rapid. There's a lot of interest getting in the marketplace. So you frame what you want to trade. You want to trade as little as an hour a day? Okay, I've already told you that. You want to trade a full kill zone, 2 hours, 3 hours? Okay, I've told you that too. I can't trade New York. I got to trade London. Okay, I told you how to trade that. All these things are there. Now, what did I teach you about the trading day in terms of the opposite end of the range? If the whole idea was to run up, have a market reversal profile, and we have a market maker sell model here, this drop down below these relative equal lows here, what time can it arrive? When can it arrive at the target of reaching below that? London close, 10 o'clock to noon, New York local time. 10 o'clock to noon. Friends and neighbors, that's not random. That's all part of the things I've talked about all throughout the teachings of this entire YouTube channel. You have to know more than just a couple things that do the market maker sell model and buy models. So I've been very honored to be your mentor here. I've been honored to be a conduit to share all these things that I've collected and authored over the last 30 years. It's been a wonderful experience. I've been touched by so many of you as students. I have been moved to tears for some of you with all the adoration and respect you've shown to me, and I'm so thankful for that. But like all things, all good things must come to an end. And I am married to a woman that demands more of my personal time. And social media and mentoring has taken a great deal of that. So I want you all to know that it has been a pleasure to be able to be in this seat as a teacher, as a role model for learning how to trade and read price action. I want you all to know that none of the content on this YouTube channel or my Twitter will be deleted. None of it will be augmented. And I wish you all nothing but success with it. Until I talk to you next time, good luck and good trading.